Now for last month, I've been seeing a lot of concerns online. People were posting everywhere asking the imminent or potential market crash that we might go through this year. I even have some clients messaging me and asking, hey, should we be selling everything, keep as cash, just in case, and then wait for market crash to buy back in? And just so happened that last Monday, July 19, the market across the board dropped around 2%, which is the biggest drop of 2021. And most investors were attributing the big drop to inflation and also the worry of COVID and the Delta variant. So for this week, what I want to do is talk about investing and also what happened on last Monday, why such a big drop, and why it probably has nothing to do with inflation or the Delta variant. And also talk a little bit about how we can prepare for a potential or imminent market crash that everyone is so worried about. So most likely you have investment portfolio or you think about investing, then this would be a good video for you. Now without further ado, let's get started. Alright, so let's first talk about the market drop last Monday. So as you can see on the screen, major indexes have dropped across the board on that day, around 1.5 to 2%. And then when Asia market opens, their indexes drop just as well. And if we look at the VIX index, which largely measures investors' anxiety and fear in the market, it has also spiked on that day. However, one thing to keep in mind is just because VIX is spiking or it's high at some times and indicating a lot of fear, it does not necessarily mean that market will drop at the same time. For instance, in the 3 months between August 8, 2017 to November 8, 2017, the VIX was up 19%. Now, this seemingly suggests anxiety among market participants and indicating that the S&P 500 should be on a downward trajectory. However, S&P 500 was busy scaling all-time high during that time frame. Now, a lot of people attribute this drop to inflation worry because just a couple days before Jerome Powell, which is the chair of the US Federal Reserve, gave his biannual testimony to the Congress on the economics. In there, he largely repeated two things that he has always been repeating, which is number one, inflation is transitory, it's not here to stay, and number two, economy is still a long way off from returning to normal, which means bond buying from the government and money printing will continue. Now, during this month, US June CPI also released and it rose 0.9%, accelerated from the May's 0.6%. Year-on-year CPI is 5.4%, exceeding the 4.9% expectation by economists. If you look at core CPI, which excludes energy and food because those are volatile, it has rose 4.5% year-on-year, which is also very high. Now, some investors would look at this and say, hey, this is very similar to what we have been experiencing in March and April, which again, the market is kind of flat and it's kind of unstable during those times because of inflation risk. But this time is actually different. And how can we tell? By looking at the long-term US bond yield. So on the screen, you're going to see the 10-year US bond yield. Now, as you can see during March and April, bond yield actually went up to 1.75%. So why does yield ever go up? Well, one of the major reasons why bond yield will go up is because people are dumping bonds. When people are dumping bonds, demand and supply curve, they would have to raise the bond yield higher to attract new investors to come in and to consider buying the bonds again. And why are people dumping bonds? Well, that's because they were actually, for real, worried about inflation during that time. And we actually talked about this in our Ultimate Guide to Inflation video. It was actually based on Lynn Alden's research, and in there at the end we talked about different types of investment and how they will fare against inflation. And when we talked about bonds, we said that bond actually gave us very poor performance during inflation but excellent during deflation period. And the reason it's poor is because usually bonds will pay interest and the yield out to investors, but if there's inflation, then that means those yield doesn't mean much because you're losing a lot of purchasing power with those interests. So whenever there's a serious worry about inflation, investors are going to dump bonds, which in turn will boost the yield curve as we see in March and April. However, last Monday, the market dip is completely different. Stocks are down, but so is the bond yield. So we said that when bond yield is up, that means a lot of people is selling bonds. That's why they have to raise the yield. Well, the opposite is going to be true. When yield is down, a lot of people is actually buying into bond on that day. So what that means is during that day, people are actually selling stocks. That's why it dropped. There's a sell-off and they're transferring the money into the bond market. And that's why the yield is also dropping as well. When that is happening, investors is signaling that they are making switches to their portfolio, but it's not because of inflation. Because if it was about inflation, they would be dumping stocks and dumping bonds at the same time. So we will see stocks go down, bonds yield go up, And where the money goes, well, they will probably use the money to buy real estate, hard asset, because during actual inflation, hard asset is what's going to go up the most. But we're not seeing that here. They're selling stocks, dumping into bonds. So this indicates it might be something else. So this is why for this time, it seems like inflation is not a major concern for most investors. So let's look at the second problem, which is COVID. Now, before I continue, as a quick reminder, I have a group on Facebook that's private and you can ask different questions in there. We have almost 4,000 members. So if you haven't already, click the link in the description below to request to join. Now, there has been a lot of development and concern with the Delta variant. For example, Japan have reinstated the state of emergency. They have Olympic going on right now. They have banned all spectators. And if we look at US, their infection rate has doubled from July 4th, 13,000 to July 18th, 32,000. Now, this is to be expected because it's exactly 14 days after July the 4th, where a lot of people are going out and celebrating. But one thing to keep in mind is even though rate has increased, even for Canada, our rate slightly went up as well. Infection is highly concentrated in low vaccinated areas. So Director of CDC in US have claimed that 97% of death, hospitalization are unvaccinated people. Now, some people were saying that market is dropping on that day because people looking at the case numbers is worried that we're going to go back to shutdown or will slow down the economic recovery. However, what we can do is look at some COVID numbers and see if that's really the case. So looking at official data, here you can see the cumulative case. Now they're showing US, France, Germany, Canada, and UK as a default. So we're just going to stick with those. Now you can see that there's a slight uptick for US and France. It's flat for Germany and Canada. And there's a huge uptick for UK. Out of all these countries, other than Canada, Delta variant actually dominates other country cases. You can see it's very, very high percentage. Looking at next graph, we can see that people with at least one dose vaccination rate is quite high for all countries on the screen. Now, as for double dose, it looks like we are at 50% done for all countries. However, if you look at US look like it is slowing down for one dose around 55%, but for two doses, they're at 48%. So what that means is they are going to see major resistance of vaccination rate at around 60%. Now, even though maybe the vaccination rate is not going to be as high as some people hoped for US anyway, the fact that vaccination rate is over half already, and we can see a significant drop in the death rate as well. So you can see on the screen that, case fatality rate is low. ICU percentage is also very low compared to what we were getting before for all countries on the screen here. So while confirmed cases is going up, which is predicted in every single model, as summer, places are opening up, people are going to go out and celebrate and eat outside, and also some places may not require masks, case will go up. The important part here is that ICU and death numbers are remaining extremely low for all countries with high vaccination. And like CDC director said, if severe cases of death do happen, 97% of the time, it's for unvaccinated people. So while the numbers may look a little bit worrying because of the jump in cases, as of right now, there should be no real worry of economic slowdown due to the Delta variant, because it does seem like vaccines are working as intended. So why then? Why is the market dropping on Monday? Well, the simple explanation is it's just a natural pullback and small correction. So if you look at Dow, S&P, and Nasdaq, we are at a historical high right now. And if you look at the S&P 500 PE ratio, which is a good indication to see how hot or overheated the market is, our PE ratio right now is at 46.87. We are currently at third highest right now, and last two being 2001 dot-com bubble and 2008 great financial crisis. A median PE since history is around 14.86. Now, if you pull a number that's closer to the last 10-20 years, you're probably going to get 20 or maybe 25. However, it doesn't matter which one you're looking at. We're still a good amount higher than the median. And anytime our market is this high, investors will get nervous. And this is also why the VIX index is high. People are just more anxious naturally. So the smallest trigger, for example, case numbers going up, could lead to a sizable sell-off as we saw on Monday. So I would argue that it's not really about COVID itself doing damage to the economy as we saw last March. It's more about any sort of negative news will trigger some sort of sell-off just because people are very, very nervous right now. So this is also why there's a lot of posts going online asking like what is going to happen. And some clients or their friends that they refer over also brought up like, What do you think is going to happen? When do you think the market is going to correct or drop? And the real answer is that nobody knows, right? I for sure don't know. And if anybody tells you they know, I'm pretty sure they're lying or they're just making things up. Now, if you do ask me to guess, I would guess that it is more likely to happen after summer, anywhere between September to December. That's what I would guess if you ask me to guess. The reason why is because during those times, summer is over, people are coming back. If they were traveling within the country or outside the country, it doesn't matter. The fact is, they're most likely going to spend a lot more money compared to last summer because they have 2 years of traveling to make up. If that happens, then when they come back, they're starting to look at their saving plan, look at their bills. They're more likely going to pull some money from their investments to pay those bills. So if investors are nervous and most normal investors are going to be pulling out money or at least don't have a lot to keep investing to add more into the pot, and the fact that there are still a lot of different news like inflation, COVID, or political tension or whatever coming up, yeah, then I would see all those combined, September to December is probably going to be a lot more volatile than what we're seeing in the summer, and it could lead to some sort of correction or sell-off. So the last part would be, well, how do we prepare if we know market is very high and it could correct, it could crash, it could sell off at any moment? Well, for me, that's easy. My own recommendation to myself and people around me whenever they ask is to stay invested. Invest the money that you are okay to see temporary loss for now. So obviously, if there's a money that you're using for a house at end of this year, a couple months from now, you don't want to be investing those money. But if it's money that you were okay to invest a long term anyway, like your RSP for example, or maybe even TFSA, those money should stay invested. You do not need to sell off your investment right now, keep as cash, and wait for a drop to happen and buy back into the dip. Because the fact is, even though pullback and sell off is more likely to happen since things are so high right now, there's no telling when it will happen. It could happen tomorrow. It can also happen 12 months from now. And as we have talked about before, you can see on the screen here, this is what is going to happen to your investment if you keep investing for long term, but because of selling and buying, you have missed some best trading days on the market. Just by missing a dozen best trading days in the last 2 decades, you could end up from making money to losing money. However, this is different from me saying don't make any adjustments. If you have investments that you have made a lot of return, for example, Nvidia, right? After the split and acquiring ARM, which I have talked about in my other videos previously as well, it has gone up significantly this year. If you want to take some profit out because you feel like this stock is very, very high right now, you should do so. You should do those kind of adjustments. I just mean don't do drastic changes like sell everything, keep as cash, and wait for a correction to happen. Because more often than not, time in market beats timing the market. So it's very important for everyone that as things are heating up and getting a little bit anxious for everyone, to calm your mind and to have a good mindset and also a plan on your investment portfolio. That is what's going to help you if a crash does happen, so you can stay calm and make the necessary adjustment. For our clients, we have gone through 2 major crashes for last 5 years, the 2018 sell-off, and also last year COVID, the market crashed 30% in 2 weeks. Everyone stay invested. Yes, there will be temporary loss during those times, but all we need to do is stay calm and make adjustment within the portfolio as necessary. And when we get through those times, we have a lot of positive gains by the end of the year. Now, what I want to do is hear from you, your investment strategy. If you feel like the market is very hot right now, how are you investing to protect yourself? Let me know in the comment down below. And if you like these kind of videos, I do upload them 8:30 EST every Tuesday. So make sure you like and subscribe to my channel. Click the bell button so you get all the notifications in the future. Alright, this is Jacky. I hope you found this interesting. I'll see you next week. Bye!